If you told me 2 weeks ago that silver would crash from $121 all the way down to $79, I would have called you absolutely crazy. But here we are on February 9th, 2026, watching silver trade at $79.11 per ounce. And the big question everyone's asking right now is this: is this the buying opportunity of a lifetime, or are we walking straight into a trap that could cost us even more money? Stay with me, because by the end of this video, you're going to have all the data you need to make your own informed decision about what's happening in the silver market right now. Let's talk about what just happened, because this wasn't just any ordinary pullback. We're talking about a collapse that erased over 40% of silver's value in just a matter of days. On January 29th, silver hit an all-time record high of $121 per ounce. Think about that for a second. Silver hadn't seen those kinds of prices in modern history. People were euphoric, social media was flooded with predictions of $200 silver, and everyone thought this rally would never end. Fast forward just 11 days, and we're sitting at $79. That's not a correction, that's a demolition. As of today, silver is up 1.45% from yesterday, which gives us a tiny glimmer of hope. But when you zoom out and look at the monthly chart, we're down 7.1% over the past 30 days. However, and this is important, if you zoom out even further to the yearly view, silver is still up a massive 146.76% from where it was a year ago. So we're in this really strange situation where silver has been both incredibly successful and incredibly painful, depending on when you bought in. Now, you might be wondering what on earth caused such a dramatic collapse in such a short period of time. Well, it wasn't just one thing. It was a perfect storm of three major factors that all hit at once. The first domino to fall was the nomination of Kevin Warsh as the next Federal Reserve Chairman. Now, if you're not familiar with Warsh, he's known for having very strong views against maintaining a large Federal Reserve balance sheet. In plain English, that means he's more hawkish on monetary policy, which typically isn't great news for precious metals, because tighter money supply and potentially higher interest rates make assets like silver less attractive compared to interest-bearing investments like bonds. The market started pricing in this shift in Fed policy, and that alone was enough to shake investor confidence. But then came the second blow, and this one was the real killer. The Chicago Mercantile Exchange, or CME, decided to increase margin requirements on silver futures from 11% all the way up to 15%. Now, if you're not a futures trader, let me explain why this matters so much. When you trade futures, you don't have to put up the full value of the contract. Instead, you put up a margin, which is like a deposit. When the CME suddenly increases that margin requirement by 4 percentage points, anyone who is highly leveraged, meaning they had borrowed a lot of money to bet on silver, suddenly faced a choice. Either pour massive amounts of additional capital into their positions immediately, or close out their positions and take their losses. As you can imagine, most people couldn't come up with that kind of cash on short notice, so we saw forced liquidation on an absolutely massive scale. It was like watching dominoes fall, where one person's forced selling triggered margin calls for other traders, which triggered more selling, and the whole thing spiraled out of control. The third factor that contributed to this crash came from an unexpected source. Treasury Secretary Scott Bessent publicly attributed the extreme price swings to Chinese traders, describing what we saw at $121 as a speculative blow-off. Essentially, he was saying that the top was driven by speculation rather than fundamental value, and when a high-ranking government official makes that kind of statement, it tends to spook the market. Whether his assessment was entirely accurate or not, the mere suggestion that the rally was built on speculation rather than solid fundamentals was enough to accelerate the sell-off. Here's something crucial to understand about why silver moves so much more violently than gold. Silver is a much smaller market with much thinner liquidity. What that means in practice is that it takes far less money moving in or out of silver to create massive price swings compared to gold. Think of it like this. Gold is like an ocean liner that takes a lot of force to change direction, while silver is more like a speedboat that can turn on a dime but also get tossed around much more easily by waves. The volatility we're seeing right now in silver is actually matching levels we haven't seen since 1980, which was the last time we had this kind of speculative mania in precious metals. Currently, the gold-to-silver ratio is sitting around 50-1, which means it takes 50 ounces of silver to buy 1 ounce of gold. Historically, when this ratio gets too stretched in either direction, it tends to revert to the mean, and some analysts argue that silver is still undervalued relative to gold even at current prices. Now let's talk about what's actually supporting silver's value beyond just speculation, because this is where things get really interesting. For the second consecutive year, industrial demand represents over 50% of total silver consumption. This isn't your grandfather's silver market where it was primarily an investment vehicle or used for jewelry and coins. Today, silver is absolutely critical to modern technology. We're talking about solar panels, electric vehicles, electronics, 5G infrastructure, and a whole host of green energy applications. The transition to renewable energy that governments around the world are pushing for requires massive amounts of silver, and that demand isn't going away just because prices got volatile. In fact, analysts are projecting a structural supply deficit in the range of 160 to 200 million ounces for 2025. Let that sink in for a moment. We're consuming significantly more silver than we're mining, and unlike gold, which mostly just sits in vaults after it's purchased, silver gets used up in industrial applications and can't easily be recovered. This creates a fundamentally tight supply situation that should, in theory, support higher prices over the long term. On the supply side, we're facing real constraints. Silver mining isn't easy to scale up quickly. It can take years to develop a new mine, and many silver deposits are actually byproducts of other mining operations, particularly copper and gold mining. If those primary metals see reduced production, silver supply gets squeezed as well. We've also seen some nationalization trends in major silver-producing countries like Mexico, which creates uncertainty about future supply. The bottom line is that even if demand were to remain flat, which it won't because industrial demand keeps growing, we'd still be facing supply challenges. So where do we go from here? This is the million-dollar question, or in this case, the $79 question. Let me walk you through 3 different scenarios that analysts and forecasters are currently debating, and then you can decide which one makes the most sense to you. The bullish case is being championed by analysts at Gold Silver, who are forecasting that silver could potentially reach $175 or higher based on the industrial demand story we just discussed, the supply deficits, and long-term fundamental support. Their argument is essentially that the recent crash was just a shakeout of weak hands and over-leveraged speculators, and that the underlying factors driving silver higher haven't changed at all. In fact, they argue that pullbacks like this create generational buying opportunities for patient investors who understand the long-term trend. If they're right, buying silver at $79 could look like an absolute bargain a year from now. The moderate case comes from analysts at UBS, who are taking a more measured approach. They're predicting that silver will recover back to the $100 threshold by next month, so we're talking about March 2026. But then they expect it to pull back and settle around $85 by the end of the year. This scenario suggests that we'll see some near-term strength as the market digests the recent sell-off and bargain hunters step in, but that we're unlikely to see a return to those $121 highs anytime soon. This is kind of the Goldilocks scenario where silver recovers but doesn't go parabolic again. So what could actually trigger each of these scenarios? For the bullish case to play out, we'd need to see a few things happen. First, industrial demand would need to remain strong or accelerate, particularly from the solar and EV sectors. Second, we'd need physical buying to overcome the paper-selling pressure from futures markets. And third, we'd probably need some kind of catalyst like a weaker dollar or concerns about inflation returning to drive safe haven demand back into precious metals. For the moderate case, we basically need stability. No major shocks to the system, steady industrial demand, and a gradual rebuilding of confidence after this volatility shakeout. For the bearish case to materialize, we'd probably see continued strength in the dollar, further tightening from the Federal Reserve, or a slowdown in industrial demand if the global economy weakens. There are several key catalysts coming up this week that could push silver in any of these directions. We've got crucial U.S. jobs and inflation reports that will give us insight into Federal Reserve policy. If inflation is running hotter than expected, that could actually support silver as an inflation hedge. If the job market is weaker than anticipated, that might hurt industrial demand expectations but could also delay Fed rate hikes, which would be supportive for precious metals. We're also watching Chinese economic activity closely, especially as they come back from the Lunar New Year holiday period. China is a massive consumer of silver for industrial purposes, so any signs of economic strength or weakness there will matter. And of course, geopolitical developments always have the potential to drive safe haven demand, whether that's tensions in various global hotspots or unexpected political developments. Now let's address the elephant in the room. Is silver at $79 a buy or a trap? Here's my honest take, and remember, this is educational content and not financial advice. You need to do your own research and make decisions based on your own financial situation and risk tolerance. The case for buying right now is pretty compelling if you're a long-term investor who believes in the industrial demand story. We're talking about a 40% discount from the recent high, a massive supply deficit that's structural rather than temporary, and growing industrial applications that aren't going away. If you have a multi-year time horizon and you're willing to stomach volatility, this could indeed be an attractive entry point. The year-over-year numbers don't lie. Silver is still up nearly 150% from a year ago, and we've simply given back some of those gains. However, the case that this is a trap is equally valid, especially for short-term traders. We've seen extreme volatility, forced liquidation, and negative sentiment. The technical picture is damaged, and there's no guarantee we've found a bottom yet. Those support levels at $72 to $76 are uncomfortably close, and if they break, we could see another leg down. If you're someone who's trading on margin or can't afford to see your position go down another 20 or 30%, this might not be the right time to jump in. The prudent approach for traders might be to wait for a confirmed bottom and some stabilization, even if that means missing the absolute lowest prices. There's also the question of how you want to gain exposure to silver if you do decide to buy. Physical silver in the form of coins or bars gives you actual ownership of the metal, but you'll pay premiums above spot price, and you'll need to worry about storage and security. ETFs like SLV or PSLV offer easier liquidity and no storage concerns, but you're trusting a fund structure rather than holding the physical metal yourself. For most investors, some combination might make sense, where you hold some physical for long-term security and some ETF exposure for easier trading if you want to take profits or add to positions. Position sizing is absolutely critical here. Given the volatility we've just witnessed, putting a huge percentage of your portfolio into silver at any price point is probably not wise unless you have an extremely high risk tolerance. A more measured approach might be to scale in over time, maybe buying a third of your intended position now, another third if we see those $72 levels, and holding back some capital in case we go even lower. This way, you're participating if we rally from here, but you're also protected if we see further downside. The worst thing you can do is go all in at one price point and then have no capital left to average down if you're presented with even better opportunities. Here's the bottom line as I see it. Silver is at a critical juncture right now. We've experienced one of the most dramatic sell-offs in modern precious metals history, wiping out over 40% of value in less than 2 weeks. The causes were a perfect storm of policy changes, margin requirement increases, and speculative excess unwinding. But underneath all that noise, the fundamental story hasn't really changed. We still have a massive supply deficit, growing industrial demand that's tied to long-term trends like electrification and renewable energy, and a market that's much smaller and thinner than gold, which means the potential for significant price appreciation when sentiment turns positive again. Whether $79 is the bottom or we have further to fall is impossible to know with certainty. But what we can say is that the risk-reward proposition looks more interesting now than it did at $121. The key is to approach this with your eyes wide open, understanding both the opportunities and the risks. Don't invest money you can't afford to lose. Don't use leverage unless you're an experienced trader who fully understands the risks, and don't expect a smooth ride upward even if the bulls are ultimately right about higher prices. Silver has proven once again that it can be incredibly volatile, and that's probably not going to change anytime soon. So now I want to hear from you. Are you buying this dip in silver? Are you waiting for more confirmation that we've bottomed? Or are you selling and getting out while you still can? Drop a comment below and let me know what you're thinking and why. I read every single comment and I love hearing different perspectives on these markets. If you found this analysis helpful, please give this video a thumbs up and subscribe to the channel, because I'll be putting out weekly updates on the silver market as this situation develops. We're living through a really fascinating time in precious metals, and I want to make sure you have all the information you need to navigate it successfully. Thanks for watching, and I'll see you in the next video.